Hello again, fellow BeachBum traders. Thank you for watching our video on how to make money trading the midterm elections, wherein we will help you understand what could midterm elections mean for the stock market. We'll explain some of the politics of the stock market, particularly focused on the politics of the stock market around the midterm elections. We'll talk about the historical results of the stock markets after midterm elections. We'll talk about how midterm elections affect the market performance. And we will talk about this as in 2022. We'll talk about if the 2022 midterm elections will be any different, potentially any different from the historical averages in terms of market performance following the 2022 midterm elections. So again, we'll try to answer a lot of questions around how potentially the midterm elections in general, and specifically in 2022, the midterm elections may affect the stock market performance going forward. So stick around. We will also, towards the end of the video, share with you a number of investing and trading strategies, techniques, etc., that can help you learn how to make money trading midterm elections. So we hope this all helps. Let's get started. If you have not already seen our other video titled How to Make Money Trading Elections, we would highly recommend you also view that video. You can find a link to the video on how to make money trading elections in the description box below. And in that video, it will answer some general questions about how to make money trading elections, including how do U.S. election results influence the stock market, and if so, how do elections affect the stock market? We'll also provide you with a number of investing and trading strategies for trading the various years in the what they call the presidential election cycle, or the presidential economic cycle. So again, we'd highly recommend that you also view this video titled How to Make Money Trading Elections, and you can find a link to that video in the description box below, as again, that will provide you with more information and more investing and trading strategies on how to make money trading elections in general. Okay, let's explore the politics of the stock market, in particular relative to midterm elections. This is a recent article by Forbes, and I'll put the direct link to this article in the description box below that explains the politics of the stock market relative to midterm elections. So we can see in this case right now, we're talking about the 2022 midterm elections. You can see that this article strives to be a nonpartisan. So you can see they point out that the S&P had a total return of 24% after Trump was elected. Likewise, the stocks had a total return of over 40% in the year that after President Biden was elected in 2020. And they point out there's too many other factors that impact the stock market to attribute the performance to one person, regardless of party affiliation, especially since the government also has two legislative branches. They point out in 2022, the stock market was trending down, which was a typical path for an election year, for a midterm election year since 1962. They say stocks have historically bottomed in October and rallied by an average of almost 32% the next 12 months. So stocks have been positive in the year after every midterm election since 1942. So again, to kind of answer this question on the impact of midterm elections on the stock market, whether it's attributable to the midterm election, they're pointing out that stocks have been positive in the year after every midterm election since 1942. They have a graphic, and let me zoom into this graphic a little bit. So we can see the number of 12-month periods following midterm elections with a negative return is 0. Average performance 1 year after a midterm decline is 31%, 31.6% positive. Average decline during a midterm year is minus 19%. So again, that's a typical historical average year. So they point out, Mark Twain is credited with the saying, history doesn't repeat itself, but it often, or it does rhyme. I like that quote. I think it's very apropos. There are reasons to be concerned with the rhyme. Again, we're talking about 2022. So a recession has not begun in the third year of a presidential cycle back to 1929. So this fact and luck probably help explain the lack of a down 12 months in stock after a midterm election since 1942. Unfortunately, the historical streak of no recessions is likely to end again 2022. Talk about the Fed. So here's a number of recessions starting in the year of the presidential cycle. So the majority start in year 1. 9 of the recessions start in year 1, only 1 in year 2, 0 in year 3, and 5 in year 4. So historically, the probability is not in year 3, but probability higher in year 1 or year 4. So again, we hope this gives you a general idea of how midterm elections potentially affect the overall politics of the stock market, and then we'll look in other aspects, other opinions, other effects that the midterm elections may have on the stock market. Look at an additional article with some additional information about the history of how the stock market has performed after midterm elections. Here's a Forbes article titled "The Stock Market Has Risen After Every Midterm Election Since 1950." And I'll leave the direct link to this Forbes article in the description box below so you can read it in more detail. Again, this is a recent article as of 2022. So, they're talking specifically that the stock market's been down in 2022, or September, etc. But before you sell everything, it's worth considering at least one bullish catalyst in the horizon. Voters head to the ballot box on November 8th. So date is clear. Midterm elections are historically bullish for the stock market. So again, the message here is midterm elections are historically bullish for the stock market. So since 1950, there's been 18 midterm elections, and in the 12 months following each of those cycles, the stock market has had positive returns. So they show a nice graphic of the percentage of the returns after every midterm election, and the average 1-year total return after midterm elections is 18.6%. After all other years is only 10.6%. So again, the average total returns in the year after midterm elections outperforming the average for all other years. So U.S. stocks consistently earn positive returns after previous midterms with an average return of 18.6% compared to 10.6% in all other years. So if we look out 2 years after previous midterm elections, the average return has been a blistering 33.7%. So then they show for 2 years after the midterm elections, you can see 6 months forward, 16.1, 12 months forward, 18.6, and 24 months forward after midterm elections, the average return is 33.7%. So again, the conclusion is that the stock market has risen after every midterm election since 1950, both in the near term 6 months, the 12 months after, and the 24 months after. So I hope that all helps. Okay, let's look at another opinion on what could midterm elections mean for the stock market. This is an article by Morningstar, recent article by Morningstar. I'll leave the direct link to this article in the description box below. We can see one of the highlights is they're concluding to pay closer attention to economic and geopolitical catalysts than on the election. So that's the conclusion again of this article, that economic and geopolitical catalysts mean more for the stock market than do the results of the midterm elections. So they're talking about, again, this is 2022, so the outcome will have ramifications as to the next congressional agenda, including fiscal policy, spending priorities, potential changes in tax policy. Many investors' minds, the question is, should I alter my investment portfolio either before and or after Election Day? And their conclusion, in their view, their opinion is the answer is no. The markets are influenced more by expected financial conditions and economic catalysts and by midterm elections. So again, that's the short answer to should you make any changes based on midterm elections. The answer is no. Pay more attention to financial conditions, economic catalysts, and they're recommending investors focus on the overall market valuation and economic outlook and not on the results of the midterm elections. So what we can and can't learn from previous midterm elections. Historically, analysts have shown equity markets have tended to underperform in the run-up to midterms and then outperform thereafter. This course of events should suggest that investors should be underweight prior to the election, then move to overweight after. Again, this is historical, so it can be skewed based on the years that are chosen, etc. In addition, the results differ greatly depending on how far back, starting during the Great Depression, after World War II, and after 1962. Dynamics of the market today are very different from the earlier periods. Again, they believe that the stock markets are influenced more by expected financial conditions and economic catalysts rather than midterm election results. So again, in this particular, in the 2022, they're pointing out a number of factors that contributed to the drop: slowing rate of economic growth, tightening monetary policy, high inflation, rising interest rates. For the foreseeable future, these headwinds will continue to exert greater impact on the markets than the midterm election results. Volatility will remain elevated until these headwinds begin to abate. So here's some historical examples of stock market activity leading to the midterms over the past 30 years. Numerous instances in which stock market volatility leading up to the midterms has coincided with either deteriorating fundamentals or external catalysts. So they consider factors over the past 30 years. So in 2018, the market fell through autumn, through the midterms, didn't bottom to the end of 2018. And again, they're picking specific examples. I'll let you read these in more detail, the specific example years. But 2014 dropped by 1.8%, 2010, 2002. Again, these are specific examples that had specific events around them. The conclusion, the solely attributing the volatility to the run-up should be taken with a grain of salt. Even if you predict the outcome correctly, your bets may not pay off. Depending on the outcome of the election, there will be sectors and companies that may be affected more positively or negatively than others. So they don't recommend trying, holding a controlling or blocking position in government is fraught with risks. So they're saying don't buy or sell stocks based on the party that will hold controlling or blocking position in government. Even if you correctly predict the outcome, the investment implications are far from certain. Numerous factors limit the scope that the party will be able to accomplish. Both domestic and economic factors, as well as external geopolitical factors, may arise to derail the controlling party. can also be precarious to project the timing of when the party will be able to enact new legislation and how quickly the related spending will occur. They give an example in 2020, passed legislation that boosted spending on renewable energy. Only a few of the stocks have outperformed the broad market since that. Combination of underlying long-term fundamentals and valuation are much more important to long-term investment success than trying to pick winners and losers based on potential government intervention. So that's, again, one of their conclusions. So what should investors expect in the foreseeable future? Markets are looking for clarity as when the economy will regain its footing and begin a meaningful maintained rebound. Looking for inflation to subside and trend downward. Until these are evident, we expect the markets will remain essentially volatile and surge or purge as economic and inflationary metrics are released. So again, in 2022, their expectations are that GDP, gross domestic product, will remain sluggish, won't start to grow until end of or second half of 2023. Fed will conclude tightening by the end of 2022. Momentum may push interest rates slightly higher over the near term, but rising long-term rates has already occurred. Inflation will begin to moderate over the next few months and subside in 2023. Earnings growth will remain sluggish. Companies with significant international exposure will be under added pressure from the appreciation of the U.S. dollar. Liquidity will be drained as the Fed's quantitative tightening program allows $95 billion worth of U.S. Treasuries and mortgage-backed securities to roll off its balance sheet. And they conclude, say they think the combination of these factors will provide the Fed with room it needs to begin easing monetary policy in mid-2023. Again, that's their particular opinion. So what's an investor to do in their opinion? In their view, investors are better off sticking with long-term plans based on your investment goals and risk tolerance. The plan should incorporate a range of allocations in order to take advantage of changes in market valuations and periodically rebalance your investment allocations. When market valuations drop lower, you have the opportunity to judiciously add to equity market exposure. When the market recovers, you can lock in gains and reduce equity exposure back to your long-term allocation target. When the market trades above fair value, it's time to underweight equity exposure. According to 700, a composite of approximately 700 stocks Morningstar covers, the broad equity market is trading at a significant discount to fair value. So again, their opinion as to where the market's currently trading. Time for investors to consider adding to their equity exposure. The recent rally since end of September is trading at the market's trading at a 19% discount to fair value as of their opinion. They're saying the growth category is trading at a 24% discount to fair value, closely followed by stocks in the value category, which are trading at approximately 19% discount. Core blend category is much closer to fair value and only trades at 11% discount. According to these calculations, it appears that the best relative positioning is a barbell of an overweight in growth and value and an underweight in core blend. Again, this is all their opinion. So hopefully, though, that this helps you see what could midterm elections in general and specifically in 2022 mean for the stock market. And again, their overall conclusion is or recommendation is to pay closer attention to economic and geopolitical catalysts than the results of the midterm elections. Okay, let's look at another article from the New York Times. They're talking about the market usually rises after the midterms, as we pointed out. Will this time be different? So this is an article in the New York Times from October of 2022. So it somewhat focuses specifically on the 22 midterms, but hopefully a lot of these points are applicable to midterms subsequently too. So they say with worries about the economy rising, the 4-year presidential cycle for stocks may not follow the established pattern. So if you have money in the stocks during this bear market, you're probably having a rough year. The bond market's been miserable too. Surprising degree of consistency over the past 100 years or so. Stocks have followed a broad pattern that coincides with presidential terms. The months leading up to midterm elections have generally been the worst in what's known as the 4-year presidential election cycle, but the stock market is about to enter a sweet spot. Stocks have usually rallied in the year after the midterms, no matter which side wins. So again, they're pointing out it doesn't really matter who wins. The year after the midterms, the stocks have usually historically risen. Market veterans take these patterns seriously, but aren't counting on them in an economy plagued with soaring inflation, rising interest rates, and fears of recession. So they say we've studied the presidential cycles carefully, and there's something to it. This is a chief market strategist from Federated Hermes, but it's possible that this year we will need to invoke the 4 most dangerous words in investors' lexicon. This time is different. So again, they're going to look at, is this year 2022 after the midterms potentially different? So consider this: overall pessimism in the markets, current climate. We're now entering a stage where all signs point to a recession, assuming we aren't already in one. And you all have heard my opinions in those regards and our game plans, etc. The recession may already be priced into the markets, in which case the next bull run may be faster and come earlier than many investors expect. So latest government figures show the economy grew at 2.6% annual rate in the third quarter. Fed says interest rates need to rise due to high inflation. Fed's monetary tightening is aimed at slowing the U.S. economy, and the consequences for working people will be savage or mild, or if they will be savage or mild isn't clear. So in the meantime, we've got the pandemic, Russia's war in Ukraine, interest rates rising, global energy costs elevated, U.S. relations with China fractured, so a lot of negativity, uncertainty. So here's some discussion on the 2022 midterm elections. Democrats and Republicans head in the final stretch. Some battleground races yet to be determined. So it's indeterminate who's going to control the Senate. Democrats mounting anxiety, failed to unite. Social Security and Medicare. So Republicans eyeing a midterm victory, floating changes to safety net programs. So that's a galvanizing topic, debunking misinformation. So here they're debunking 5 of the most widespread voting related claims. So the presidential cycle, the party of sitting president tends to lose seats in Congress in midterm elections, and high inflation makes matters worse for incumbents. Key findings, Yale economists, an election model, and again, I put the direct link to this article in the description box below, and you can dig into each of these linked articles as well. So relies on economic factors, shows the Democratic Party in an uphill climb. This model aligns with polls and the predictive markets, and many forecasts suggest Republicans are likely to win control of the House of Representatives. The Senate's up for grabs. The issues are enormous, vast differences between the parties. Yet for the stock market, history suggests that the outcome of the elections may not matter much. So again, who wins really doesn't matter much to the markets. So shocking though this may be, since 1950, the midterm elections have brought an upturn for stocks no matter which party has won and no matter the issue. So again, midterm elections have brought an upturn in the year following the midterms, no matter which party wins, no matter what the issues are. So the market's been flagging, often excelled in the year after the midterms, typically the best of the 4-year presidential cycles. So here's an independent investment research firm, compared stock returns from 1948 through 2021, broken down 4 years of a standard presidential term using the S&P 500 and a predecessor index. So the returns were 12.9% for year 1, 6.2% for year 2, the year of the midterms. The year following the midterm, 6.7% for year 3. The year after the midterm, 7.3% for year 4. Similarly for the Dow, going back to 1900. So they're asking why, and there's no clear answer. It's maybe even a series of coincidences, but plenty of explanations. One they prefer is that presidents are politicians who try to stimulate the economy and indirectly bolster stocks for maximum effect in presidential elections. Their first year is the best time to make politically painful moves, which often lead to weak markets by the time of the midterms come around. After losses in the midterms, presidents try to give the economy a surge through expansionary fiscal and monetary policy, setting themselves or their successors up well for the election. So is this an exception? Is this time different? Two powerful factors they point out: negative effect of a slowing economy, beneficial influence of the midterm elections, maybe conflict. On the positive side, Wall Street usually responds well to gridlock, so the status that can grip Washington when power is divided. And such a division is the consensus expectation for these midterms. But over the last century, when bear markets have been associated with recessions, no bear market has ever ended before a recession started. The last time there was a recession, the year following the midterms, occurred after the 1930s election during the Great Depression. So a recession would be expected to be more important than the election cycle. So some practical steps that you may take. There are many ways of making bets on specific election outcomes, though they entail risk. If the Democrats defy the odds and hold on to both parties, infrastructure spending will be expected to increase. ETF research, okay. Intelligent infrastructure companies like Badge Meter supplies utilities and water metering equipment. STEM, which provides software and engineering for green energy storage. If you want to bet on gridlock, you may assume that split government will be bullish for the overall market. Then again, the need to raise the federal debt ceiling in 2023 could become a market crisis. Republicans have vowed to use the issue as leverage, forcing Biden to cut federal spending. Similar maneuvering led to a downgrading of U.S. Treasuries in 2011, sending tremors through the global markets. Tactical bets on election or economic outcomes are unreliable. Long-term investing in diversified stocks and bonds using low-cost index funds and track the, okay, so your common mantra. Short-term, try to fortify your portfolio and build up your cash so you can handle any economic or electoral outcome. However the stock market behaves, this is an important election. So I hope that all helps. Again, this is an article in New York Times about will 2022, will the results of the midterm elections affect the markets differently this time? Although the market usually rises after the midterms. And again, I'll put the direct link to this article in the description box below, and you can read it in more detail at your leisure. So I hope that all helps. So here's another article by Charles Schwab, and their opinion: will midterms affect market performance? You can see it's a recent article from 2022. Again, I'll leave the direct link to this article in the description box below so you can read it in more detail at your leisure. But they state stocks tend to outperform after midterm elections. Will the trend hold? So again, in 2022, will this trend that markets tend to outperform after midterm elections, will this hold? So they point out the correlation between stock market performance and midterm elections is well documented. 17 out of 19 midterms since 1946, the market performed better in the 6 months following an election than it did in the 6 months leading up to it. So in 2022, the market performance has already diverged slightly from the average midterm election year. So we can see the yellow line here is the S&P index average performance in U.S. midterm election years. So this is the average performance. We can see in 2022 it has underperformed significantly. So weeks since the start of the year. So you can see in 2022 it's underperforming the average for a midterm year. So returns are for midterm election years going back to 1930. Obviously, from past performance, no guarantee of future results. So the upcoming midterms are coming. Can we expect similar strong post-election performance into next spring? Post-election outperformance is often driven by the market's expectations of increased government spending from a new Congress, but an additional infusion of funds seems unlikely given the government's historic levels of spending and stimulus in response to the pandemic. In fact, all the money is one contributor to the 40-year high in inflation, and new spending would exacerbate the inflation issue further. So the combination of high inflation, the war in Ukraine, a lingering pandemics have already made this cycle unlike prior midterm years. So many other forces at play in the market. This author wouldn't put much weight in historical mid-year performance. So this author is saying, this time could be different. It could diverge from the historical trend. However, again, stocks tend to outperform after midterm elections from a historical average standpoint. So again, I'll leave this article, the link to this article in the description box below, and you can read it in more detail at your leisure, but we hope that all helps. Okay, if we also look at this article under the link for presidential election cycle in this New York Times article about the midterms, see the mid-market usually rises after the midterms. Will this be different? And again, if we click on that link about the 4-year presidential election cycle, it brings us to this article, again, for which I will include the direct link to this New York Times article as well in the description box below. This is back from 2010, but again, it talks about the overall presidential election cycle, and there's some specific information about 2010, but the general presidential election cycle data, they're saying, we're entering the sweet spot of the presidential election cycle, and it's hard to bet against it. They say data going back more than a century has found that stock market has generally done much better in the second half of a president's 4-year term than the first. If history is a reliable guide, big if, the market outlook should be brightening. Since 1942, 200 days after a midterm election, it produced a remarkably consistent uptrend, regardless of who wins. So again, remarkably consistent uptrend regardless of who wins. This report, they found in all 17 instances, the S&P 500 gained an average of more than 18%. Are the numbers a fluke? It's possible. There isn't a lot of hard evidence. Presidential election history is too short for the patterns to be statistically rigorously significant. Still, many people surmise it reflects the simple desire of politicians to get themselves and their parties reelected. He quotes, I think a president's elected tries to get rid of the dirty stuff in the economy as quickly as possible so that by the time the next election comes around, he looks like a hero. Started analyzing in 1968. Stock market is reacting to what the politicians are doing. If the causes aren't clear, the numbers are startling. There's a strong historical tendency for the market to trend higher over the course of the 3rd year of the presidential cycle. The average annualized returns for the Dow Jones from 19 to 2009 for year 1 is 5.5%, 3.7% for year 2, which again is the midterm year, 12.6 for year 3, which is the year after the midterms, and 7.5 for year 4. So he states the pattern strong enough to count as remarkable. Pattern's quite remarkable. So you got several quotes that say that this pattern is remarkable. Cautiously bullish views on the market. They tried to map the cyclical stock market returns to a deeper political business cycle, but didn't find significant correlations to factors like inflation or interest rates. So they're not able to come up with an explanation. But in this paper in 2008, they found evidence of a political business cycle corresponding closely to the election calendar. From 1961 to 2004, the money supply tended to start rising in the second year of a presidential term, followed by a rise in GDP. So he concluded the idea of the Fed is divorced from politics and from real world affairs and conducts matters from an ivory tower setting. It's more of a myth than a reality. And then he goes through an example of the Nixon era. So I'll let you read that the specifics of that example. He points out there isn't enough information for formulating an investment strategy based on this election cycle. However, it's another important arrow to have in your quiver. So again, hopefully we've helped you add another important arrow to your quiver, another tool to utilize in your trading and investing strategies to help you succeed in your trading career. So hopefully in this video we've helped you learn how to make money trading the midterm elections. Hopefully we've helped you answer some questions like what could midterm elections mean for the stock market, helped you understand some politics of the stock market related to midterm elections specifically, helped you understand the history of the stock market performance after midterm elections and how midterm elections could affect the stock market performance, and how potentially the 2022 midterm elections might be different from the historical averages. And again, we provided you with a number of investing and trading strategies, trade ideas for trading the midterm elections, and specifically around 2022, but also generally for any midterm elections. So hopefully this has all helped you learn how to make money trading midterm elections. Please let us know in the comments below, in our free Discord, in our Facebook group. What other strategies do you know of that would help you on how to make money trading midterm elections? Again, let us know in the comments below, in our free Discord, in our Facebook group, etc. We hope this all helps. Good luck and have a great day. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You could also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the BeachBum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading Community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So thank you for your consideration. Another way that you can help support BeachBum Trading and being able to produce frequent quality content for you for free on YouTube, etc., is in addition to subscribing to our BeachBum Trading channel, hitting the like button on our videos, and hitting the notify so you're alerted when we release further videos. You can also choose to show your support for BeachBum Trading with a super thanks, which you can find below this video. If you hit the heart with the $sign, the super thanks, again, you can financially support BeachBum Trading in whatever amount that you wish, and we greatly appreciate your support, and that will help us, again, be able to produce frequent quality content that we can provide for you and all your fellow BeachBum traders around the world for free on YouTube. So again, we greatly appreciate all of your support, and thank you very much. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.